Welcome back to Business Undercurrent, where today we're exploring a fascinating stock market paradox from 2026. Memory chip giant Micron just reported one of its best quarters ever. Revenue nearly tripled, growing an incredible 196% year over year, while earnings exploded by more than 680%. With numbers like these, you would expect the stock to soar, right? But here's the twist. The stock actually dropped 4% in after-hours trading. What makes this even more confusing is that at the same time, major Wall Street banks raised their price targets on Micron by a whopping 25 to 52%. This isn't just random market noise. It's a window into a massive structural shift happening in the world of technology. Please note, this content is for informational and educational purposes only and is not financial advice. So what's really driving this apparent contradiction? It all comes down to the insatiable demand from artificial intelligence. AI is incredibly memory-hungry, requiring enormous amounts of specialized, high-speed memory to function. Think of it like launching a rocket. It doesn't just need more fuel. It needs a completely different and more powerful kind of fuel system. In the world of AI, that special fuel is called high bandwidth memory, or HBM. Micron is now in full production of HBM4, specifically for NVIDIA's advanced AI systems, and this business alone is already generating an $8 billion annual revenue run rate. But here's the real kicker that shows how much the market has changed. Micron has completely sold out of all its high-speed memory for the next 2 years. This unprecedented demand signals that the memory business has fundamentally transformed from a cyclical industry to one with sustained, long-term growth. Now, this is where the paradox gets even more interesting. The main reason the stock dropped after such a stellar report is that investors are worried about sustainability, particularly around profit margins. Micron's gross margin hit 81%, a figure that is near its historical peak. This led many investors to think, here we go again, this must be the top of another memory cycle. However, Micron's CFO, Mark Murphy, is challenging that old way of thinking, arguing that AI is a long-term secular driver, not a short-term cyclical one. The proof is in their spending. Micron is investing over $25 billion in capital expenditures this year, with even more planned for next year. That isn't the behavior of a company at a cyclical peak. It's a massive bet on persistent, ongoing demand. And despite this explosive growth, the company is trading at just 8.3 times its estimated 2026 earnings, which is remarkably cheap. This is why analysts like those at Barclays see as much as 52% upside from here. So what's the real story that this paradox reveals? This isn't just about Micron. It's about what Micron's situation represents for the entire tech landscape in 2026. AI isn't just another software trend. It's a revolution that demands a massive and persistent investment in specialized hardware, especially memory. And that critical hardware is now in very short supply. When you see a company like Micron spending billions on new factories while booking orders 2 full years into the future, you are witnessing the infrastructure of the AI revolution being built in real time. The memory chip paradox shows that the market is still underestimating just how structural and permanent this shift is. What if AI-driven memory demand is no longer a cyclical commodity that booms and busts, but is instead more like a utility with constant, growing demand? That's the bet Micron is making, and it's why analysts are raising their price targets to levels that would have seemed absurd just a year ago. The companies that recognize this fundamental shift early are the ones that are set to win the AI infrastructure era.